All right, guys, let's talk about how are you even going to purchase these properties. I know that's the very first thing that comes to mind when you even hear about rentals is, hey, I don't have any money, or I have a limited amount of money, or I have some money, but I'm not sure how the process even works, so we're simply going to go over it pretty quick. The very first one is your traditional 20% down. You guys are probably familiar with that. Let me go ahead and say that all lenders and mortgage brokers are different, okay? Just because you go to one lender or one bank doesn't mean that's exactly how the other banks will do it. Some may require 25%, maybe a bigger deal is 30%, maybe a smaller deal is even 5%, okay guys? When you're looking for traditional banks, your brick and mortar banks, go and ask them what's their lending criteria for doing rental properties. How many will they let you do? Some people have a amount that they don't want you to go over, or a dollar amount you don't want to go over. And so we're talking about just the traditional way. I find a property, I put 20% down, and I buy it that way. Okay. The next is FHA or VA loans. Now, precursor, you cannot buy FHA or VA properties on a loan with the intent to use it as a rental unless it is 4 units and under, aka the house hack. Like if you want to buy a duplex, a triplex, a quadplex, anything over 4 units is considered commercial. You're not going to be able to get into this world with that. But let's say FHA, meaning you simply have never bought a home before, VA being you're a veteran, thank you for your service, and they will let you get a loan at even 0% down. Should put that here as a 0% down for your VA loan if you have enough VA credits, entitlement credits. If you want to go down that rabbit hole, simply put in VA entitlement credits in Google, and that'll tell you how to calculate your loan. But you can simply put even 3.5% down, and in some cases, in some states, you can even get that down payment into the purchase, depending on where you're at. And so if you want to live in one of the units and rent out the other 3 units, which to be honest, I don't necessarily recommend because it can be a headache when you're basically living with your tenants, but you could do that with one of these types of properties in there. Now, FHA, I believe, has a 2-year minimum if you move away or a job transfer or something that you can now transfer your VA property into a rental. Obviously, life happens. And that's what happened to me. My very first property, I was in it for 2 years and needed to move, and I put a tenant in it and had a FHA loan. But that is how you get around maybe using one of these low down payment loans and still buy a rental property. The next one is what you hear is debt service coverage ratio, or asset-based lending on the secondary market. Usually you'll use a mortgage broker to find you one of these properties. You can simply Google that and find the type of lenders that use this type of lending where they're basing the loan off of the asset. It's not necessarily your credit. It's not necessarily how much cash you're putting down, but it's generally off of what the cash flow is, the value of the property, and all the terms are negotiable on that. But I've done these type of loans as well. And there's a lot of advantage to that. One of the downfalls is they may put a prepayment penalty, which is not ideal in there, especially if you're going to fix and flip it. You don't want to do that. But if you're going to have a long-term hold, they may put a prepayment penalty where you'll owe them a certain amount of money if you exit this transaction in a certain amount of time. Okay, so you have to weigh the pros and the cons for you. I don't necessarily recommend doing that. I've been in that position before. Thank goodness it was a long-term buy and hold, and that fell away after a certain amount of time. But you can definitely get loans based off just the value of the property without being concerned maybe with your credit score or your financial situation. The next is, and we've done plenty of deals like that, guys, is seller financing, subject to, wraparound mortgage, lease option. These are just creative terms for doing a creative finance deal with the actual seller. Seller financing being that the seller is going to turn into actually the bank. The property is completely paid off, and they're going to create a mortgage note, and they're going to finance you the property. Maybe with like a balloon payment where you will owe them a certain amount of money in the future. So maybe they do a 30-year mortgage, but you have a 5-year balloon where in the next 5 years you'll need to refinance through one of these other loans. Subject to simply meaning you're going to take over the payments for the seller on their property, subject to their current mortgage, where you step into the seller's shoes and take over that property. Maybe you give them some money to exit that property, but that is another way to take that property over. You can do a combination of even the both, what's called a wraparound mortgage. Maybe the seller still has a loan on the property for, let's call it $200,000, and they're willing to wrap another mortgage around that, a secondary mortgage for $100,000, and sell you the property for basically $300,000. And if that deal makes sense and everything cash flowed and it was worth it, you'd be able to do both that, make the seller's payments on their mortgage, and then have a wraparound mortgage where you basically pay the seller directly. And of course, a lease option, which isn't the most common, but is a way to do it, where you go into a purchase agreement with a seller. Maybe they had a vacant rental. You said, hey, look, this is what I'll put down as a lease option, and 5 years from now, I will exercise my option, but I want to sublease the property out to someone else during that time so you can get cash flow, and in the future, you can exercise your right to buy that property for a predetermined price in the future. Okay, so these are just some very vague examples of some creative finance ways you can take down a property. A lot of you guys hear about the BRRRR method. Simply, I buy it, I renovate, I rent it out, and then I refinance the property. It's a way for you to put a ton of cash into a property and then get it back out. So simply using really easy numbers. Let's say the property's worth $200,000. You buy the property for $80,000 and you put $30,000 in the property to get it where it needs to be. You then put a tenant in the property, and then you go to refinance all the money back out that you had. Maybe you find a asset-based lending or even traditional lender who says, well, you already have more than 20% or 30% equity in the property. You may even come out ahead on this deal where you refinance it, you have none of your own cash in the property, and they even cut you a check at the day of closing. Okay, I've definitely done this one before as well. I don't base my entire business model around it. A lot of people do, and there's nothing wrong with that. I'm just not playing a long-term debt game, so that's why I don't do all my properties that way. But there is some definitely advantages to the BRRRR method. No lack of information online about the BRRRR method, so if you guys want to know more about that, simply look it up online. And of course, the simplest, the easiest, the highest cash flow way to do it is the cash method. Okay, I know, I'm probably going to get a lot of hate for that one, telling people just to go out and buy a property in cash. But I highly recommend it. I have properties paid off in cash. I like paying properties off in cash. I like the cash flow. I like to leverage the properties and have a line of credit on those properties in case I need that cash, so I still have access to the capital. I like the peace of mind if tenants don't pay, my property's paid off. I still have insurance and maintenance, but there's nothing like not having that debt or that monthly payment coming out of my account every month. So I enjoy building my portfolio, paying things off in cash. If you say, hey, look, how's that ever going to work for me? Then I would highly suggest getting your active income, your wholesaling, your flipping, your 9-to-5 job. Get that to pay you as much as it possibly can. Your side hustles, generate some cash, start paying properties off, and so you can leave generational wealth to your family. Let me know, guys, are you guys buying rentals? How are you guys buying rentals? What kind of structure are you guys buying rentals currently? Leave me a comment below, and I'll see you on the next video.